Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. I was thinking about the upgrades that we need in our retirement portfolio. So, Art, I'll start with you on this one. What is the biggest upgrade that you see that most adults need to make?
Depends on what stage they're in, but we see a lot of people coming into our office in that retirement red zone. So we're going from growth planning to income planning, and there's a shift that has to happen, kind of mental shift. And a lot of people are very aggressive, and they're too aggressive, moving into the income phase of their retirement. So kind of repositioning their portfolios to make sure that if we have a 50% correction in the market, or like this year, June was kind of the bottom of the market right now. When you go through a 25 or 30% correction, are you ready for that? Can you handle that? Are you going to have to delay retirement, or can you take that less income pool and just reposition the portfolio so it's not so volatile and it's not so extreme? That's a lot of what we see when people walk in the door.
What about you, Luke? When you're working with a client, you're going through their portfolio, and I know y'all take a complimentary deep dive into portfolios with that initial consultation, but what adjustments or renovations do most people need in theirs?
Most people need to realize that if they've saved in a traditional 401k or IRA, that about a third of it is going to go to taxes. And people tend to have a misconception of, okay, I've saved this $1 million. I'm retired. I want to take out $200,000 and pay off my house. Mm-hmm. Well, that $200,000 pull from your 401k could cost you 24% or 32%. So then you're paying off maybe a mortgage that's a 3% mortgage with money that, $200,000 really costs you almost $260,000 to do. So I think people don't factor in the taxation. And also, when you start having taxable income, your Social Security becomes more taxable. Your Medicare premiums go up. Your capital gains tax goes up. So it's all a big snowball that you've been kicking down the road for the last 30, 40 years of your life. So if you're still in savings mode, there's potential for you to save differently. If you need income, there are different ways we can utilize our CPA here, Mark Bernard, to help you on your tax strategy.
772-281-5223. You can always find more information online at artofmoneyradio.com. And Art, it came out, the new CPI number is at 8.5%. Does this inflation rate now at 8.5%, does that mean we're getting some relief from this record high inflation?
It means hopefully what Luke and I have been looking for, we've hit peak inflation. Mm-hmm. But still, 8.5 is not much different than 9.1, right?
Right.
So there's not much change yet, but the good news is it's not continuing to go up. So the Fed's not going to have to chase with rates still. So that pressure being off the Fed should make a big difference in how the market responds, and we've seen it. So our bottom was in the middle of June. We've already been bouncing off of those lows, and the market is reacting to that. So the good news is the Fed doesn't have to continue to rise like crazy to try to get inflation under control. It looks like they've done that. Looks like things have slowed some. So as long as things don't change going forward and things continue to slow down, we should be in pretty good shape.
Yeah, and it feels, most of that CPI was from energy and oil dropping. It feels like energy and oil is still falling a little bit, especially with news out of China this last week. Some of their economic numbers were a lot worse than expected. And China is actually cutting rates. So you have the United States raising rates, you have China cutting rates, you have the European Central Bank just got to zero. They were negative for a while. So we're going to see, hopefully with, the United States and the Federal Reserve pretty much being the only main economy raising interest rates right now, that hopefully that helps us fight inflation and lower things as other countries are kind of doing different.
772-281-5223. Is that still what's on the mind front and center of most of your clients right now? Is it still this record high inflation? Is it the interest rates? What is on the mind of most of your clients?
I'd say inflation is on the mind of most, and then what actions the Federal Reserve will need to do to get us, to even lower inflation, to get us down to 2.5-3%. Historically, the Fed has needed to raise the Federal Reserve rates above the CPI rate in order to fight inflation. Anytime inflation has been above 5%, this has been the case. So with that being said, the Fed's going to need to keep raising rates. The CPI is going to keep falling. So that's a big concern with clients is the CPI rate, inflation rate. But we also have a lot of clients asking us about mortgage rates. And mortgage rates peaked out a little bit at around 6%. Then they dropped under 5%, and now they're in the 5s. So we're seeing a lot more inventory on homes and even some price drops out there in the market. It's going to be hard to exchange a mortgage at 3% if you currently have one for one at 5 or 6.
Mm-hmm. Art, it's kind of funny that we're seeing the CPI at 8.5%, and we're all like, oh, that's great, good. It's not record. A couple years ago, 8.5%, we'd be shaking our fist. What is happening? But now it's like, hey, it's dropping. Things are looking pretty good.
Yeah, and it's just exactly, everything's relative, right?
Yeah.
But yeah, trying to get the consumer prices way down is a big important factor, because if you talk about 8.5% inflation, it's bad enough when it's 2 or 3% inflation, which is typically what it's been in the last 25 or 30 years, because in a 10-year period at 3% inflation, you have a 30% loss of buying power. So what $10 bought 10 years later, it's only like $7. So you've got to be able to have your money grow and make enough interest to offset the loss of purchasing power. So you want to have in 10 years $13 for that $10, so it still feels like 10 because you're going to need 13. So we build that into our modeling for our clients because they have to have that in their income planning. So if we're taking $10,000 a month out for retirement income today, they're going to need $13,000 a month in retirement income planning in the future. And that's at 3%. So if it's 7 or 8%, then we're going to need a whole lot more because you're going to have 50% of that money erode. So, we use the rule of 72 a lot of times in here when we're calculating interest and things like that, but you can also use the rule of 72 for inflation. And you're talking about a real big hit to money over time. So we don't want inflation to stay at 8.5%. That is not a good thing. We want those prices to drop in that 3, 4, 5% range again.
772-281-5223. How you reach out to the team at the McPherson Financial Group. Tell me about the rule of 72 when it comes to inflation affecting your retirement plan.
Well, it's the erosion of your purchasing power. So you're basically talking about how fast does our money become less valuable. And we want to talk about it in terms of real world. So I always try to bring everything to real world. And when you go to the store and you buy something, I remember when I was a kid, we were paying $0.25 for a gallon of gas. I remember when we had the original gas lines under Jimmy Carter. My dad always would have Friday afternoon. He would try to get off early, have the boat out. So as a family, we'd go out in the boat and then have the boat available all weekend. Well, one of the big things was filling a couple 5-gallon gas cans for the boat, or maybe 3 or 4. And I just remember him being in line and he was not happy and he was frustrated, and it was only $0.25 a gallon. Well, now we're paying about $4 at the pump a gallon. So that tells you the difference right there. I remember when I was going to elementary school, I would go into the grocery store and sometimes I'd use my lunch money to buy bubble gum, and then I would end up selling it at the school so I could have more lunch money by the time lunch came around. And I could buy a candy bar for like 25 cents back in that day, and now you run into a 7-Eleven or anything like that, you're paying $1 plus, for a candy bar. So that's where you see inflation. So when we build a retirement plan for our clients, we have to factor that in, because unfortunately, I'm 52 now. So I'm talking about when I was a kid and I was only 12 years old, things like that. So 40 years ago, you can see the difference of the power of money. So we want to build a retirement plan that over 20, 25, 30 years, now, however long our clients live, that we have enough money today. And then we also have enough money in 10 years, and we have enough money in 20 and 30 years that they can keep pace with those inflation numbers, and they can keep pace by getting more money to them, and then also paying the tax on it. Because one thing that we factor is you may jump a bracket or two because you need more pool, more income, and we got to pay the tax on that. So we factor that in too.
Mm-hmm. So the actual rule of 72 minus Art's story time and going back to buying bubble gum. So if inflation stays at 9%, let's just say 9%, the cost of everything will double in 8 years. So you divide the inflation rate or your rate of return into 72. That's how many years it will take for whatever you're trying to figure out to double. So from an inflationary standpoint, right, if things are at 9%, everything will double in 8 years. So that's the rule of 72. And we use it the opposite direction too, right? If you're earning 7% on a portfolio, your money should double in 10. But when you think of it in the inflationary standpoint, thinking of prices of things doubling, and we've seen things in the CPI index that have more than doubled, right? Gas doubled, but your groceries didn't double. They're way up, but they didn't double. So it's a pretty scary situation if you go out 8 years and think of things doubling. I don't think that will happen, but the Fed's going to have to raise rates and keep it going.
772-281-5223. 5223. That's how you reach out to Luke McCarty, Art McPherson, and the team at the McPherson Financial Group. If you hear anything this weekend you need some clarity on, you're ready to get serious about how inflation is affecting your bottom line, let them take a look at your portfolio, see what adjustments need to be made. Again, no cost, no obligation to you. You can find all this information, artofmoneyradio.com. And another conversation I'm sure you're going to have is about annuities, because we often talk about annuities, which offer a guaranteed stream of income in retirement and protection against outliving savings. Is now a good time to buy that annuity, or can it really help, recession-proof a portfolio?
Well, it depends what you're buying the annuity for. So here's a good example. I had some clients come in last week, new clients, and we're talking about the stock market. We're talking about, bonds, mutual funds, ETFs, individual stocks. And she said this more than once. She says, Luke, I cannot lose any money. I said, well, over time, the market usually, she goes, nope, she cut me off again. I cannot lose any money. Well, if you're in that boat where you can't lose any money, and it may not be with all your money, just a portion or whatever you're considering, right? What do you usually run to? The bank. Mm-hmm. And the banks are paying nothing on savings rates. The best CD rate I've seen recently is around 2%. And that was brand new. And you have to open a new account and probably deposit, X amount of money. Well, given that a CDs too, we have some, they're called multi-year guaranteed annuities. In the 3-year range, that pays close to 4%. We have some in the 2-year range paying 3.5% per year. So if you're thinking about a CD, if you have cash on the sidelines, 3.5% or 4% is not going to beat inflation this year, but it's a heck of a lot better than your savings account paying you 0.05. I know mine's paying pretty much nothing, which is concerning. So we have some options there on the annuity side, and that's just one type of annuity. We don't use those very often because for the longest time there has not been an interest rate, and those are typically in the 1% to 2% range where we would say, hey, probably not worth it. But you're starting to see 3s and 4% guarantees. It feels like a pretty good investment or something we should consider looking at now.
And it's for those people that just don't want to have any risk at all. So they don't want any downside risk. Just like Luke was saying, no, I can't afford to lose money. So it's that kind of a client.
Yeah. Now's a great time with cash to buy something. No. I said, yes, ma'am. I heard you loud and clear. I will not talk about that anymore.
Art, who would not benefit from having an annuity right now? Because as we talk about them, it's pretty much guaranteed income for life. Who wouldn't it benefit?
Well, everybody, I think, benefits if they understand it. It's just annuities have gotten a bad rap because typically they come with sales charges and commissions and fees. And a lot of times people aren't told exactly what's going on with an annuity product. Mm-hmm. So if you were to do an example like what Luke was saying, we're talking about an annuity that has no upfront cost to the person. But if they were to get out of it prior to that 3-year period, then there's a sales load on there. There's a sales charge to them where they get pulled back in that money. So they have to be careful there, and they have to make sure they follow the rules. If they follow the rules, they're a great product, but you just have to be careful about the fees, things that are, and you have to read the fine print. So we do a lot of that for our clients because we're fiduciaries. So we do the fine print, fine reading to make sure that it's a good fit for them and that you're really matching risk and return. So if you can get a 4% return and after 3 years, you can take all of your money and walk with no fee, no charge, that's a pretty good product. But a lot of annuities are 10-year products or 15-year products, which work great for income planning if you're doing an income because you can do like a pension payout, things like that. You just have to match it up properly with what you're doing. Where a lot of people get hurt with annuities, and Luke and I see this, is all of their money gets put into them and they don't have the liquidity. Mm-hmm. That's where annuities are very dangerous because they're a great long-term product, but they're not liquid. So you got to make sure that you have a basket of annuities where you have different maturities, and then you can't put all of your money there. You need money that's liquid all the time.
Not for everybody, but could it be right for you? Let's find out. Give the team of the McPherson Financial Group a call. 772-281-5223. When you reach out to the team, tell the representative, I want to sit down with Luke McCarty. I want to sit down with Art McPherson. I want them to take a look at my plan. Let's talk a little bit about annuities and that initial consultation. No cost, no obligation to you. One more time, 772-281-5223.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174725.
Today's show has been a work of art.